Under the environment of financial institutions, there are two types of environments. So let me write it. Environment of financial institution. All right. So under this environment of financial institution, there are two types of environments. We have the micro environment. So this micro environment is known as the internal environment. Then the second one is a macro environment. Under this macro, this is known as the external environment. So when we talk about micro environment, these are the business environment that are within the control of the entity. That is why we call them micro. So there are those business environments that are within the controls of the entity. So meaning you have power over them, you have control over them. That is why they are known as what? Micro. So anything that you can control is micro. So they are within the control of the entity. So those are what is referred to as what? Micro. So there are some variables of this micro environment that you need to watch out for. There are about 6 variables of micro environments that you need to watch out for, which are those factors that can influence your microenvironment. Although you can control them, but they can influence your microenvironment. The first variable is the suppliers. Okay, suppliers are the first variable. Then the second ones are your competitors, right? Competitors are the second variable. I'm going to explain each of them. Then the third one is the customers. Recall that we've discussed this thing before in our tutorial. Then we have the intermediaries. Then we have the financiers. Then last one is the public image. So these are the 6 variables that we have in microenvironment. Remember that microenvironment, they are those environments that are within the control of the entity. So let me help you write it. They are the environments that are within the control of the entity. So these are the 6 variables that triggered microenvironments. Your suppliers, your competitors, your customers, your intermediaries. Intermediaries, e.g., examples are your supply chain, those that handle your delivery for you. They are known as intermediaries. Those that handle your deliveries, those people that you engage to help you perform one or two services. Then financials, e.g., banks. So these are all these things, the variables that you need to look into when you are discussing micro environments. So these are the variables that you need to look into under the microenvironment. Then there are some threats to microenvironment according to Portas. So there are about threats to microenvironment. What are the threats to microenvironment? There are some threats to microenvironment according to Porter. The first threat is the threat of a new entrant. The threat that somebody will enter the market and distort how things are done. So the first one is threat of a new entrant. So this is number one threat to a macro environment. Threat that a new competitors will enter the market and disrupt. So that's number one threat to a micro environment. Threat of a new entrant, right? Then the second threat under the micro environment, having reviewed the threat of a new entrant, is known as a threat of substitute. Threat of substitute. So this is the threat that customer will prefer to go for other product. Threat of substitute. So under the threat of substitute, that customer will not buy your product again and move on to other products. That is what threat of substitute is all about. The threat that the customers won't buy what you are selling again. Then the third one is the negotiation power of customer. Negotiating, why am I typing this? Negotiating power of customer. Negotiating power of customer. So here, these are the conditions that the customer can actually price you out of the market. They can price you out of the market, or when new people keep coming and offering the same service that you are offering at a much cheaper rate, that's a threat that you need to look into. So all these 5 threats, they are by a man known as what? Portas. Then the last one is industry rivalry. So these are what you need to know under the micro environment. Remember that micro environment, they are those environments that are within your control. something that happens around you that you can still influence or you can control. And there are 6 variables that determines that trigger microenvironment: your suppliers, those that supply you goods, customers, competitors, intermediary, financiers, and public image. So these are the variables there. The threat to microenvironment, according to our reporters, these are the threats to microenvironment, right? The first one is threat of a new entrant. Then we have threat of substitute, threat, negotiating power of customer, industry rivalry. Then we also have negotiating power of suppliers as well. So these are the 5 threats that you need to know. Should in case we are to write 5 threats of microenvironment according to authors, these are what we are expected to write. Okay, moving on, because I'm just doing a quick summary tonight since we've reviewed Kiki. I think Kiki treated this thing first with us. Now, what is a macro? The next one is, let's move on to macro. Macro is something that is large, right? So macro simply means something that is large, something that is not within the control of the entity. So they are those environments not within the control of the entity. So anything macro is large, is not within your control. Okay, e.g., you cannot determine your company can't determine what inflation rate should be. You can't determine what interest rate should be. You can't determine what CPI should be, consumer price index. You can't determine what exchange rate is going to be. So these are all the factors that determine macro environment. So whenever you want to analyzing macro environment, analyzing macro environment, then you need to make use of the variables too. So the variables in analyzing macro environment is known as PESTEL. PESTEL. I can bet it with you. If you have money, let's bet. This is likely going to come out. Do you know why? I was in school one of these Saturdays, and the undergraduates were writing exams. The exam that they are writing, professors or case exam. And one of the questions he gave them was to analyze PESTEL. So I'm suspecting this PESTEL, you guys should be, let's be careful of it, right? So PESTELs is the variables. Under the micro, we use supplier, customers, competitors, intermediaries, financiers, and bankers to analyze. But under the macro, we make use of what? PESTEL. So what does P stand for? P-E-S-T-E-L. So PESTEL, P stands for political environment. P is equal to political environment. Okay. Then E stands for what? Economy environment. Then S stands for social environment. Then T starts from technology environment, right? E stands for ecological environment, and L stands from legal environment. So this is what PESTEL is all about. So in analyzing your macro environment, you make use of what is known as what? As PESTEL. So it is PESTELs that you will use to analyze your macro environment. So let's discuss what each of these PESTELs variable is all about. So a business activities is being influenced by all these things that we have here. PESTEL. The first one is the political environment. Who is in power? The kind of government you have or how connected you have to the government can influence the success of your business, right? So if the government changes and they bring about some form of positive changes, right? Government bring out like positive policies, it can influence how business is done. So the importance of political environment is not something that you can overlook when to trading your business, right? Government policy can kill your business, and sometimes the government policy can promote your business. So political environment is very critical. However, no one can influence it, right? Then the second one is economic environment. This economic environment, basically, it's evolved around government policy surrounding the economics, like what is the interest rate, what is the exchange rate, what is the CPI. Those are the things that you discuss under the economic environment. Then the third one is social environment. So in countries like Nigeria, Nigeria is a very religious country, right? The way we worship in Nigeria is quite different from the way they worship overseas, right? In Nigeria, like this, we pray a lot. So if you are a company that you want to come and operate in Nigeria, you need to take note that public holidays, Nigerians don't joke with public holidays. That's part of our social activities. We don't joke with our public holiday. Even in some companies, when it is between 12 and 3 p.m. on Friday, they allow staff to go on for Jumats, so for you to succeed, so you must understand the culture of the countries that you are operating. So all those things comes under social environment, right? That's the social environment. Then technological environment is how fast are technological changes. If you are a manager and you don't know how to use Copilot or ChatGPT to make your job more efficient, then you are lacking a lot of things, right? As a manager now, you don't need to think too much on some things, right? So for example, you have just finished drafting a mail and you are wasting your time in looking for grammatical error where there is Copilot or ChatGPT. So you need to embrace the cultures of technologies when performing your activity. So how fast are technologies to it affects business environments, right? So technological is also a very big things that affect business environments. Ecological environment. This ecological environment, it's all about the climate change, right? The climate change, the kind of weather. Nigerian weather is quite different from the weather in Canada. Yeah, we've never experienced snow before. If any snow come out in Nigeria today, people will surround the snow and be taking picture because it's not something that is common to us. So you must consider your ecological factors, very important. Then lastly, legal environment. What kind of rule of law do you have where you are operating? So all these things are what makes up your external environment, known as what? PESTEL. So remember, PESTEL is your external environment. P is political environment. E is your ecological environment. X is your social environment. T is your technological environment. And L is your legal environment. So let me leave the business environment for now. So my people, for business environment, if you go through this syllabus, this thing that I've just taught now are those things that you need to know about business environment. Domestic, internal, and external. Don't read beyond this. Whatever I've taught you now is what you need to know about the business environment. Understand what is a domestic or internal environment or micro environment. Understand the variables and understand those threats. That is all for internal. Then when you come to external, understand the meaning of external environment and understand this first step. That is all. So with that, you are okay with this number one of the syllabus. Okay. Now, let's move on to the next one that we would like to do. That is the next one I would like to discuss with us is role and responsibility of management and board of directors. I'm sure there are a lot of big boys on this call that are directors or big madams too that are directors. So I would like to explain some of your functions as a director. So what is the roles and responsibility of board of directors? So first of all, let's define what is a board of directors. What is a board of directors? So BOD are selected individuals. They are selected individuals appointed by who? Who appoint director? Appointed by the shareholders to run the activity of the business on their behalf. That is all. So board of directors, they are a group of selected individuals who are very experienced, right? Let me put it here, highly experienced people. All directors are only highly experienced. People don't just appoint anyhow person as directors. They are highly experienced. In fact, there is a body that monitors the activities of directors in Nigeria, IOD. So for you to become a certified director, you must be a member of IOD. That's Institute of Directors. Okay. Yeah, so you must be a member of IOD, Institute of Directors. So the board of directors, they are selected individual appointed by who? Who appoint directors? Shareholders. The shareholders will appoint directors, and please note that directors, they need not have shares or not in your company, right? It is possible for director not to have one couple shares and still be the one running the business. It's not a must that directors must be the shareholders. Directors are usually industry experts. Not necessarily that they are shareholders, please take notes, but they are highly experienced in whatever thing they are doing. All right. So what are the objectives of board of directors now? Those that have been appointed as directors, what are their objectives? Number one is that the directors are responsible for selecting who to run the business. Executives. Directors are the one that appoint CEO. They appoint CFO. All those top lines roles. It is the directors that ratify those appointments. So number one objective of director is to appoint CEO. That's number. Almost now don't score. Oh, number one objective of director is to appoint CEO, CFO. That's number one objective of directors. The number two objective of director is they set objective for the business. Please, are you following me or you guys are watching Arsenal match? Hello, are we together or we are watching Arsenal match?
No, we're together.
Okay, thank you. So directors set. Thank you. Arsenal don't score, just for enough information. So number one objective of director is that they appoint CEOs, CFOs. That's number one. Number two is that they set objective. These are the objective of director. They set objective for the business. What the business want to achieve for the business. They set like a blueprint or blueprints for the business. They set these things for the business. Then number three is that they are like representing shareholders. Okay, they represent shareholders. So it is the directors that represent the shareholders too. Okay, because all the shareholders cannot be available. It is the directors that afterwards represents them. Okay, then they also protect the image of the companies and manage finance. So it is the director that approve the budget. You know, when the CEO and MD prepare a budget, they need to go and face the directors to get the budget approved. So the directors approved budgets. So they do budget approvals. All right. So these are the objectives of directors. Just know these five objectives. Number one is that they select executives, they nominate executives like CEO, CFO. Number two is that they set objective for the business, the blueprint, what the business want to achieve. Then the third one is that they represent shareholders. Okay, they are the one that represent the shareholder. They act as a representative of the shareholders. That's another one. Then they also protect the image of the companies. They protect the image of the company. And lastly is that they prepare budgets. Okay, they prepare budgets. That is no, not they prepare. They approve budgets. They approve what budget. So these are the functions of what of directors. These are the functions of what of directors. I mean, these are the objective of directors. Sorry, objective. Sorry, I'm being distracted because Madrid Rabicola is now. Okay, these are the objective of directors. So just know these five objectives. I'm sorry. Now let me focus. I'm not watching boy again. So these are the five objectives of directors. Now, what are the functions of board of directors? So just note this. What are the functions of board of directors? Number one functions is that they establish vision, mission, and core value of for the organization. Vision, mission, and core value. I'm sure we all know the difference between vision, mission, and core values. That's number one. Number two is that they set out strategies and structure for the business. It is the director that set out the strategies and culture and structure for the business. Hello? Then they also select top executives, like I have explained. Directors are the ones that appoint CEO, CFO, all those top executives. So they select top executive for the business. Then they delegate authority to management. Directors delegate authority to management. Then they approve budget, which is financial sanctions, e.g. budget approval. So directors does all these things. Then lastly is that they serve as a link between the company and the external environment. So the directors serve as a link between the companies and the external environment. So those are the functions of directors, right? So now that we have discussed the roles and functions of directors, so the next thing is management. Remember, the syllabus says that roles and functions of directors, Then after that, we have roles and functions of management. So the first thing is that you need to understand the difference between directors and management. They are not the same things, right? Directors are those selected people that are appointed by who? By the shareholders. But who appoints management? Who appoints management? Number one, directors are appointed by the shareholders, but the management, they are appointed by the directors. That's the difference. Directors are appointed by shareholders, but management, they were appointed by who? By the directors. It is the director that appoints management. Okay, so what is a management? So management is the act of getting things done. Okay, is the act of what? Is according to Peter Drunkard, is the act of getting things done. That is management through material, people, or other resources, anything, just to ensure that things move from A to B. You get things done, things move from A to B. That is what management is all about. All right. So what is the objective of management now? Optimum utilization of resources. You need to ensure that resources are properly what? Utilized. Then management are responsible for the growth and development of the business, planning for the future, and getting maximum results with minimum effort. So these are the objectives of management. So what management needs to ensure, for example, when directors appoint CEO, they give them some form of a KPI, a target of what they expect them to achieve. All right. So that is what they want them to. So I'm sure we cannot list the roles of management based on the little things I've just explained. We can list out the roles of management. So these are likely questions that they might ask again on this. So let me move on. Now, even that we have discussed this management and directors, I'm moving on to another area of the syllabus, which is performance measurement or evaluations of banks. Performance. Okay, let me hold on a bit. Any questions? I've quickly summarized two topics for us now: business environment and directors. Any questions, please, on these two topics before I move on to another area entirely? Please, do you have any questions for me? I want to move on to another area entirely now. Any question? Okay. If no questions, then I will have to continue. So the next one that I want to discuss is the performance measurement or evaluation of banks. Now, the first thing is that why do we need to measure bank performance, first of all? Why can't we just leave bank alone? Why do we need to measure bank performance? So there are a lot of reasons why we need to measure the performance of banks. The first one is for investors to have confidence. Who are the investors? The shareholders. For them to have confidence in the banks that, oh, this bank is doing well. That is because they have seen their performance. Then the second one is the risk management and financial stability. Okay. It is when you measure the performance that you'll be able to know whether the bank is stable or not. Then the third one is to comply with the various regulatory guidelines and supervisions. Then customer satisfaction and trust. So all these reasons are why you need to measure the performance of banks. So just note them because they can ask us what are the rationales for bank performance evaluation. That is, why do we need to measure the performance of banks? So please take note of all these points that I've listed here. Okay, so let's move on now. Valuation of banks. So what is the valuation of banks? What is valuation of banks? So valuation of banks, it involves assessing the worth and the value of a bank, right? When you're trying to assessing the worth of a bank, so know how much a bank's worth. That is what valuation is all about. And you normally do the valuation of a bank for two reasons, purposely. Number one is in case you want to do a public issue. Hello? Any question? So you normally do valuation of banks for two reasons, right? The first one is for public issue. Anytime you want to issue new shares, then you can do your valuations. Or if you want to do merger and acquisition, you can do your valuation. So those are the two major reasons why you do the valuations of banks. And how we do the valuation of banks is quite different from how we value normal company, because there are some approaches that you need to take note of when you are using banks. Now, the first one is there are various methods of valuing banks. You can value banks through price to book ratio. That is price to book ratio. What does this price to book ratio mean? That's you're comparing your market price per share divided by the book value of the company, right? So if your result is greater than 1, that shows that the bank has a very positive outlook. Okay, if your result is greater than 1, that shows that the banks has a very good possible outlooks. But if your result is less than 1, what it means is that you are currently overvalue your banks, meaning that what you are showing as book value is not real. You are overvaluing your bank. So this price to books ratio basically is very good in identifying, it reflects the asset and liability, making it so it's basically very good at identifying the value of your assets and liability and other exposures that you have. So that is one of the benefits of this price to book ratio. Then the second one is the PE ratio, very popular. That's price earning ratio. So here you are benchmarking your market price divided by your earnings per shares, right? So whenever you have a higher PE ratio, that shows that you have a very strong potential of earning good money in the future. But if your PE ratio is low, that's a danger. That signifies danger. So it is always advisable for PE ratios to be higher. Then we have dividend discount model. So under this discount model, you compare your D1. D1 is dividend that you paid in year 1 divided by your rate, that is your required rate of return, and you subtract your growth rate from it. I'm sure we can still remember our corporate finance to understand what this thing's all about. Then we also have a couple of methods. Excess returns model is there. There is, I think, okay, excess return model is there. There is precedent transaction analysis. Then there is discounted cash flow. Under discounted cash flow, all your future cash outflow, you discount them to the current rate. That is what discounted cash flow is all about. So these are some of the methods that you can use to value your banks. I think it was Dr. Obademi that taught us this. He just gave us some of those methods, and that's all. So please understand the method. It should, in case he requests that we should explain maybe 5 methods of valuing banks. So please take note of that. Then how do you now measure the performance, right? What are the performance evaluation indications for banks? Performance evaluation indicators for banks. So there are 2 performance evaluation indicators. We have those ones that are financials. Then we have those ones that are non-financial. So for the financials, what you are basically doing under financials is you're calculating your ratios. Then under non-financials, here you are testing all these qualitative reasons. That's what you're testing under non-financials. Financials, you are performing some ratios calculations. So examples of what you do under financials are, number 1, your return on assets. So your return on assets is your net income over total assets. So the higher the ratios of return of assets, the better for the bank. So if your ratio is high, that shows that you are generating higher returns on your assets. Then the second one is your return on equity. So return on equity your return on equity simply means what? That's your profit divided by your shareholders' equity. So here too, if the return on equity is high, that means your shareholders' value is increasing. However, if it is low, that means your shareholders' value is also what? Depleting. So that is what we have under return on equity. Then we have net interest margin. Net interest margin is your net interest income over any asset. Please note that your net interest income is your gross income, interest income minus interest expense, right? Interest income minus interest expense. So that's what is known as what? Net interest income. Then you can as well use any per shares for this. So these are some of the ratios that you can use. Then we also have some liquidity ratios that you can use to measure the performance of a bank, such as a liquid coverage ratio, loan to deposit ratio, which is your loan divided by deposit. Okay, then we also have asset quality ratio. Asset quality ratio, here you compare your non-performing loans to over total loan. So if your non-performing loan is high, then this ratio will be high, which signify that you have a very poor credit quality. That is the meaning. But if it is low, better for the banks, right? If the non-performing loan ratio is high, that's danger. If it is low, better for the banks. So that is what that is all about. Then capital adequacy ratio is also here. Then we have efficiency ratio. So these are purely your ratio analysis, right? Okay. Now the next one is non-financial performance indicator. So all what I've listed now, they are financials performance indicator. And like I said, they are basically ratios. You calculate the ratios. Now the next one is the non-financial performance evaluation. So this one does not involve finance. It is non-financials, which are the qualitative factors. Number one of them is your customer satisfactions and quality service quality. Do you know most banks, they gain new customer because of their good customer care? Okay, there are some banks, I won't mention their name, their customer care, they are old people that, you know, Gen Z cannot relate with. Imagine you go to a bank now, the person that attends to you is a very young lady, you know, that smiles well, you know, that alone gives you a positive rating, right? So that is what, those are the things that you have under qualitative, under non-financial performance indicators: customer satisfactions and service quality, your market shares and growth. The type of technologies you are using to can give you some form of ratings. I don't even know which banks in Nigeria currently have the best mobile banking app now. I think all of them always fluctuate. So digital banking and technological innovation, corporate governance. So these are all these things that we consider under the qualitative characteristics. So if you are very strong in all these things, then it's a good marks for you, is a positive for you in terms of your performance evaluations. So the other thing that they use in bank is known as CAMEL. CAMEL. So CAMEL stands for C, that's capital adequacy. A stands for asset quality. M stands for management efficiency. E stands for any, and L stands for liquidity. So this is what CAMEL is all about. So for the C now, capital adequacy. So this measure a bank's ability to absorb loss and remain solvent. So how much losses can you absorb? That's your capital adequacy. How much losses can you absorb as a company? So that's what determines your capital adequacy. Then the next one, the A in CAMEL. So C is for capital adequacy. A is what? Asset quality. C is capital adequacy. A is asset quality. So this asset quality is measured by testing your non-performing loan ratio. So if your non-performing loan ratio is very low, that implies that your asset quality is high. That's a good news. But if your non-performing ratio is high, that means that most of your debt, they are something that they are about to become bad debt. That's not a good sign for your company. So that's not a good sign. Then we have the management. M stands for management efficiency. The M in CAMEL stands for management efficiency. So this management efficiency ensure it tests how strong or how effective are the bank's management. So you calculate some ratios to test this. The first one is the cost to income ratio. The next one is the net interest margin, and the third one is the employees' productivity. So these are all the ratios that you use under the HEM, which is management efficiency. So the next one is E. The E starts from Henny. Henny simply means how profitable are you in managing the business. That's what E stands for. How profitable are you in managing or running the business? That is what the E stands for. So there are some ratios that you can use to calculate that. The first one is the return on assets, which is your profit divided by total assets. The second one is your return on equity, which is your profit divided by equity. Then the last one is your earnings per share. So these are the various things that we have under the E, which is the third one under CAMEL. Then the L stands for liquidity. So how liquid are you as a bank? How liquid are you? Okay, so you can test the liquidity through LCL, liquidity coverage ratio, or you can use your loan deposit ratio, or you use net stable fund ratio. So these are the various things that you have under HEL. So that is what CAMEL stands for. CAMEL. C, capital adequacy. A, asset quality. M, management efficiency. E is what? Let me scroll. E is earnings, and L stands for what? Liquidity measurement. So these are what you need to know under this CAMEL. So I've been able to summarize 4 topics with us tonight, right? I've been able to summarize, so I need to stop it here for now. So when we meet on Monday for this 815, our focus will now be shifted to solving questions. All right. So it is a question that we are solving on Monday. So this is the last revisions or whatever that we're having on 815. There are still some topics that I did not cover, like financial distress, organizational structures and culture. This also is very straightforward. Corporate governance. So these are more like this one's now number 7. We've done this one under 812, right? That's the role of regulatory advisory authority in the management of financial institution. We know CBN, established in 1958, commended in 1959, you know all those things. So write like 2 or 3 bullet points on their functions, and you are good with number 7. Just check our note of 812 yesterday. We discussed this particular number 7. So please check and use it to update your materials. Then liquidity too is very, very important. And lastly, risk management. So my advice for you is that before we meet again on Monday, kindly spend some time to have an understanding of the entire course outline. So we've been able to cover 4 out of 9 tonight, but I'm imploring us to please kindly spend some time and read up on everything before we meet again, so that when we meet again, it will be much, much straightforward for you guys. Okay? So any questions for me? Any questions? So I have to stop here so that we can take a breather and review and read up on our own. Then when we now meet on Monday, it will be Q&A. But still, we are meeting tomorrow for Agric to finalize, to also do a quick revision on Agric too. That is happening tomorrow. So please, any questions for me at all tonight?